The Peter Schiff Show.
Well, let me start off by wishing everybody a happy 4th of July holiday weekend. U.S. markets will be closed on Monday in observance of the holiday. Canadian markets were closed today. They had, I think, Canada Day up north. You know, it's unfortunate that we can't really celebrate, wholeheartedly on the 4th of July. And it's such a great American holiday. But unfortunately, all the traditions that we're supposed to be honoring were lost generations ago. All the freedoms and individual liberty, the values that our founding fathers risked their lives and their honor and sacred fortunes to fight for have all been lost. And so whatever it meant to be an American at one point in time, it no longer has much meaning at all today. In fact, we'd probably be better off had we not fought the war and had we still been a British colony, provided, of course, that the British treated the American colony the way they treated Hong Kong. Because, until I turned Hong Kong over to the Chinese, certainly there was a very prosperous country, one of the freest in the world. And even since the handover to China, Hong Kong remains a much freer place to live than the United States. In fact, even if we had been handed over to China and America was a Chinese colony and China treated America the way China treats Hong Kong, we'd be in much better shape than being an independent nation, because we have really screwed ourselves over in a way that King George never would have, and none of the founding fathers could have ever contemplated. Despite the success of this revisionist history Hamilton play on Broadway, the founding fathers would have hated every aspect of current America, including Hamilton. There's no way Alexander Hamilton would like anything that we're doing today. Yes, he wanted government to be slightly less small than some of the other founding fathers, but nothing like what we have today. He'd be rolling around in his grave if anybody thought that they were trying to put his stamp of approval, his John Hancock, on what we're doing. But let me get back to what I wanted to talk about on the podcast, and that is what is going on in the markets, particularly today. But today was just the capper on the week. You had silver prices up about $1 an ounce. We were up over $1 at one point on the highs. Gold closed up about 19. So gold closed above 1340. This is the highest close, obviously, of the year, of a couple of years. Silver, 1967. They're probably still doing some trades, so I don't know if that's going to be the final trade. But, there was a little bit of a pullback at the end of the day. But, to be honest, I thought we might have had an even bigger rally today with a 3-day weekend coming up. I thought maybe they could have run some stops. They might have even gotten gold above 1350, which around was the high, and maybe even $20 on silver. I can imagine that there might be a bunch of stops hanging out up there, and maybe the trading was thin, and maybe they could have reached for them. But we'll see. Maybe we're going to take those stops out on Tuesday. I mean, maybe by the time we get a chance to trade again in the United States, maybe silver will be over $20 an ounce. And who knows, maybe gold will be over not only over 1350, but maybe over 1400. This is a very, very powerful rally. Gold stocks, again, finished, I think, at 3-year highs today. If you look at the GDX, it was up about 5% on the day, actually a little over. They profit taking a little bit in the final minutes. Looks like 4.84%. At the highs of the day, we were up better than 5%. Stock market didn't do that much today, but obviously on the week, you had a pretty good gain. But the real story, other than the gold market, is in the bond market. U.S. Treasury bond yields plunging again. These are the lowest yields ever, I think. I mean, we're certainly below the crash lows of the financial crisis. The yield on the 10-year is below 1.5%. 1.456 is the 10-year Treasury. The yield on the 30-year Treasury is 2.24%. So yields are plunging. Bond prices are surging. What is going on? Because you got bonds going up and you got the gold going up. Why is that happening? The answer is money printing, quantitative easing, the most recent catalyst being the Brexit vote, which scared the hell out of everybody because of the collapse, particularly in the European banks. And so everybody was scared. And now the central bankers are rushing to the rescue all around the world. The UK, Europe, Japan, they're all in there talking about more QE, lower interest rates. And that is putting a huge bid in the bond market because obviously, if the central bankers are going to buy bonds, you want to front run that trade. You want to buy the bonds so that you can turn around and sell them to the central bankers. That is why people are willing to pay these ridiculous prices. And I bet people are starting to bet on new QE coming from the Fed, QE4, even though they're not talking about it. This is what's coming. I've been talking about it all along. QE4 is going to be bigger than QE1, 2, and 3 combined. I remember when they did QE3, they were buying $85 billion a month in treasuries. They're probably going to have to do 150 to 200 billion a month when they get QE4 going, because this bubble is so much bigger now. So we need bigger QE, and they don't have the rate hikes. See, this recession is going to be worse than the '08 recession. Why? Because recessions are about correcting the problems, the mistakes of the bubble, right? The bigger the bubble, the more the mistakes, and then the more difficult it is for the market to correct them. Well, we've had far more mistakes this time because the Fed has been much more reckless than it was under Greenspan. The last, 8 years of 0% rates and QE and everything, the Fed has done so much more damage to this economy than the damage that was done in the Greenspan era. I mean, that's why Greenspan is out now on television saying this is going to be the worst crisis ever. He knows, right? He wrote the book, and he understands how this stuff is going to play out. But it's not just because the economy is so screwed up thanks to the Fed. But as I mentioned on my earlier podcast of the week, that this recovery in most cases has been worse than the recession that we supposedly recovered from. So normally when you start a recession, you're starting from a high level, right? You had a big recovery. Everybody is in better shape, right? They repaired their balance sheets. Things are good. And then you have a recession. No, we didn't really recover from the last recession. And now we're going to begin another one. So we're starting from a level of weakness that has never existed in history when we went into a recession. So this is going to require, not really require, because require is the wrong word, because the government is, the Fed is throwing gasoline on a fire trying to put it out. But since they don't know what they're doing, and they're going to have to fight an even bigger fire, they're going to have to pour even more gasoline on it than they poured before. So since they can't cut rates more than a quarter point, because that's all they raised them, unless they want to go negative, which I think they may be reluctant to do right out of the bat. The only thing they've got is massive quantitative easing, and that's what I think people are trying to front run. They're loading up on treasuries because they want to turn around and sell them to the Fed. See, it's the ultimate bubble because it's the greater fool theory. Only in this case, the greater fool is the Fed. Right, because the Fed is going to buy these bonds because the Fed doesn't give a damn that they're buying a 30-year treasury for a 2.2% yield because they don't care how much money they lose because it's not their money. They're just going to buy it for a political agenda. And so the traders say, oh, okay, well, let's buy these bonds because the Fed's going to start buying them and we can profit. But this is a gigantic bubble. And again, it's not just the United States. I mean, Europe is in a huge bubble. You got negative yields all over Europe on these bonds. So from Japan to Europe to the United States, this is the biggest bubble ever, this bond market bubble, and it will pop. And maybe the fools that are buying the bonds, all right, maybe they will get out because they'll find a greater fool and get out in time. But this is not the right way to play it. If you really want to profit from or protect yourself from massive money printing, don't do it in the bond market, right? Don't try to pick up a penny in front of a steamroller because that's what you're doing. The smart money is buying gold, buying silver, because obviously if they're going to print all this money and buy all these bonds, silver and gold are going way up and they're not in bubbles, not even close. I mean, silver is only at about 1970 now. It was at $50 an ounce a few years ago. So it's not even close to its high. Same thing with gold. Gold now 1340-ish. The high was about 1900 a few years ago. Not even close. So why buy bonds at record highs when you can buy gold and silver instead? Especially the people who are buying European bonds and accepting a negative rate. I mean, come on. I mean, yes, gold and silver don't pay a rate, but they don't charge you. It's not a negative rate. So this is going to accelerate. I think this breakout that we had this week, I mean, I think next week could be even bigger. And because to me, it isn't even out of control yet. I mean, we haven't even seen a really, really big update. We haven't even seen capitulation on the part of all the shorts or all the naysayers. This is a very orderly increase, although it's happening day after day after day. That's why the numbers are so big so far the first 6 months of the year. But I haven't seen any kind of scramble. I mean, we haven't seen these stocks up 10 or 20% in one day. That's coming. And I think we could see much bigger moves in gold and silver as more people wake up to this reality. And again, as more people understand, why did gold and silver go down all these years? Why did the dollar go up? It was all because of this idea that the Fed was going to shrink its balance sheet and raise interest rates, and that was a farce. And people have still yet to come to that conclusion, that they had bought a bill of goods from the Federal Reserve, that all this talk about how successful QE was, it was all just talk. And all the talk about how the naysayers were wrong and how the Paul Krugmans have been vindicated and proven right, that you can print all this money without any negative consequences, that idea is a farce. In fact, I read this article today that I put up on my Facebook page. It's a really good article, PBS actual article. And the guy pointed out a lot of the truths about all the money printed, because the lie that the government's told us was, hey, we just print enough money, we're going to create economic growth and create jobs. That never happened. In fact, they said we need to print money to create inflation because the inflation is going to create growth in jobs. It didn't happen. But the real reason they wanted to print all this money was to finance government spending, to monetize government debt. And that's exactly what this article points out. And that's all we've got for all this money printing is massive government. And all this government has inhibited real economic growth and real job creation. But since everybody is still convinced that there's no downside to printing money, then why not print as unlimited amounts? I mean, it's better than raising taxes and having to incur the wrath of the voters, right? Politicians love printing money because they love being Santa Claus. They love giving out goodies to their voters. They just don't want to tax the voters to pay for them. So printing money is the perfect way to do it, right? Just, you can make promises to everybody and no one has to pay for it because we just print all this money and there's no negatives. Well, there's huge negatives, and we're about to find out. This has been a huge lag between money printing and the effect of inflation on consumer prices. But we're about to get hit with an inflation tsunami. And of course, consumer prices have been rising. That's the reality. The government has disguised that behind these doctored up numbers. But the inflation that we're about to get hit with is going to be so high that no matter how much they doctor them, they're still not going to be able to hide what's going on. We're going to get all the inflation that we should have got, because when the dollar rose, it was because everybody believed that there was a successful end to QE. When we have to do QE4, people will realize that it's never ending. When that balance sheet goes from $4.5 trillion to $5 trillion, $6 trillion, $7 trillion, the idea that the Fed is ever going to shrink it, that's going to go. And you can already see this. You can look at what's happening in the foreign stock market. You can look at what's happening with commodity prices, all starting to move up now. The markets are just getting a small taste of what's to come. And all we need is some more weak economic data. We get another jobs report coming from the U.S. on Friday of next week. And my guess is going to be another bad one based on a lot of the other numbers we've been getting. The employment components have been looking extremely weak. We got the auto sales numbers that came out today, much weaker than expected for the month of June. That was a big part of the bubble, the auto bubble. Look at construction spending numbers came out today. The last month, the April number was down 1.8%, and they were looking for a rebound in May of 0.6. Instead, they revised April down even more to -2, and instead of rebounding a +6, we got a -0.8 for May. So construction spending is falling off a cliff. Auto sales are falling. You look at, in fact, when they came out with a final revision for that GDP number, where the government manufactured some more growth by lowering what they claimed inflation was. I didn't mention on the last podcast, but there was a bigger than expected decline in consumption, in consumer spending, which obviously is 70% of that BS GDP number. So the recovery monetary heroin is already wearing off. The recession is setting in. The hangover is coming. And, these numbers, they just started to get worse. So when people start to realize that the U.S. economy is in trouble too, because the reason that the Fed is the only central bank that hasn't really been talking about having to do more stimulus is because they're still pretending the economy is good. They're still pretending the labor market is good. But neither are good. It's a disaster. And one more bad jobs report, because we got 2 in a row. If we get 3 in a row, right, the third time will be the charm, or the reverse of the charm. And maybe that'll be enough to get the Fed to join the party of having to admit that it's going to do more stimulus, but the markets are already factoring that in. In fact, for the first time just recently, in years now, the bond market, if you look at the way the markets are priced, the markets are pricing in a greater probability that the next move by the Fed will be to cut rates, not to raise them. So all of a sudden, we went from 4 rate hikes in 2016 to, all right, the Fed's going to raise rates for sure in June or July. Now, all of a sudden, not only are they not going to raise rates at all, but they're probably going to cut them. Now, the truth is, that was always the case. This is not new. This Brexit is not the reason. And the reason all these stock markets sold off, the reason the banks got crushed was not because of Brexit. Again, Brexit was just the catalyst. It's because the whole thing is a house of cards. Anything could topple it. And if it wasn't Brexit, it would have been something else. And now, of course, that's the excuse all these bankers needed to print a bunch of money, including the Fed. But what the people still don't understand is that this policy never worked. And because it never worked, doing it again is still not going to work. I guarantee you, when the Fed, when they talk about cutting rates or when they cut rates and they launch QE4, they're going to claim that it's going to work. They're going to claim that QE3 worked, that QE2 worked. Based on what proof? See, maybe they're going to try to say everything was doing great until Brexit, until all this stuff happened. And now, now we have another recession. And so we know what to do, right? Because it worked so well before, we're going to do it again. The reason we're doing it again is because it didn't work before. Because if it actually worked, right, we wouldn't still be in this mess. Brexit would have been a non-event. And if it actually worked, we would have had a real recovery. We would have actually created real jobs. Donald Trump wouldn't be the Republican nominee, right? Because people wouldn't have been so fed up. And I don't think anybody would even know who Bernie Sanders was if we had a real recovery, because we don't. Right? Maybe Joe Biden would have decided to run because, he would have just wanted to campaign on 4 more years. But this recovery never actually existed, but the Fed is still going to pretend that it did. But will the markets actually buy it? Remember, because when the Fed did QE1 and QE2, that's when the price of gold and silver really took off and the dollar tanked. It was when they did QE3, everything reversed only because people thought the Fed was finished and people thought it was going to be a successful end of the experiment. Because by the time they got around to QE3 and there wasn't a lot of inflation and everything seemed okay, then all of the fear that originally existed in the market, because when they initially did QE1 and QE2, I wasn't the only person who was out there saying this was going to be a disaster. There were a lot of other people. Remember in the presidential election 4 years ago, when they were talking about the Fed, a lot of people were criticizing the Fed for the cheap money. No one's doing that now. Remember, Rick Perry said, he called it treason, what Ben Bernanke was doing, which I agreed. But now, nobody's really criticizing the Fed anymore because all of this so-called doom and gloom that people like me were talking about hadn't materialized. Well, it's not because it's not going to materialize. It just hadn't happened yet. And so people got lulled into this false sense of complacency that everything was fine because, we printed all this money and, hey, it wasn't a disaster. Inflation was still low, at least the way the government reports it. And the stock market was going up and the real estate market was going up. So nothing bad had happened. So they kept printing, kept printing. And so then the dollar rallied and gold collapsed because everybody reversed those bets. People were preparing for a big outburst of inflation, and it didn't happen. And then everybody reversed those trades. And the dollar rallied, and gold and silver tanked. But when the Fed has to go back to the QE well, and they got to do QE4, all those fears are going to come back. They're going to come back in spades because now we're finally going to get hit, as I said, with all the inflationary forces from the first 3 rounds, and we're going to compound that with QE4. And again, we're not going to have China. China is not going to be there. In fact, there's a lot of people that are short the Chinese yuan who, again, I think they're going to get killed when that currency turns around. China is not going to be a big buyer of dollars like they were when we did QE1 and QE2. In fact, I don't think any of the emerging market economies, either in Southeast Asia or Latin America, are going to be buyers of dollars. I don't think the Russians are going to be buyers of dollars. I don't even think the Japanese are going to be buyers of dollars. I don't know anybody who's going to be buying dollars. It's just going to be a one-way drop. And we're going to have all the inflation is going to be there. We're going to have an even bigger rally in gold and silver. We're going to have a big rally in global equity markets. And though at some point, this is going to create the real crisis for the Fed, because they're going to start this program. They're going to think everything's going to be great. But all of a sudden, when the dollar tanks and the CPI really starts to move up, and now they've got themselves in this box, because now what do? Are they going to now stop the QE, raise interest rates, fight the inflation? See, if they do that, they will create a financial crisis that will make the '08 financial crisis look like a Sunday school picnic. Because then all the banks that they bailed out are going to fail again, all of them. And the government's going to have to default on the national debt. There'll be no choice. So we are now so screwed up and so levered up that if the Fed has to put on the brake now, like it should have done in 2008, it'll be a catastrophe. In fact, the catastrophe will be so big that there's no way the Fed's going to do it. So they're going to keep on printing, and they're going to ignore the increasing inflation, just like they ignored the falling unemployment rate, right? They first said, we will raise rates if unemployment gets below 6.5%, and they let it go below 5%, right? And they're still not really doing anything. In fact, they're going to cut rates again. So they're going to do the same thing on inflation. They're going to let it get to 3%, 4%, 5%, 6%. They're not going to do anything. At first they're going to say, oh, it's a good thing, or, this is helpful. No one's going to be concerned. But then it's going to get out of control. And then the Fed is going to either have to really slam on the brakes in a major way, or it's going to be runaway inflation. It's going to be hyperinflation. And, that's still the worst case scenario, but it's not impossible. But believe me, between now and then, there's going to be a lot of inflation. The dollar, I think, is going to collapse to new lows. The last time the dollar index went down, was saved by the financial crisis. It got to about 70, 71 in 2008. I think we're going to go through 70 like a hot knife through butter when the dollar starts to go down. I think we'll crash through 60, 50, 40. Who knows what the handle is going to be before we actually get the Fed to raise rates. And the price of gold, last time we stopped at 1,900 on the price of gold. Silver got to 50. Again, I think we're going to take out those milestones. We're going to take them out very, very quickly when we get up there. People think, there's no way we're going to get back up there. Look, we got up there a few years ago, and believe me, the global financial system today is in far worse shape than it was the last time silver was at $50 and gold was at 1,900. We've printed so much more money since then, and what we're about to do is going to be off the charts. So if gold and silver were able to get where they were back then, imagine how much higher they can go in today's environment. And of course, when people who are buying all these bonds at negative interest rates, when they figure that out, when that bubble bursts, there's nothing left. All those people that want to bet on cheap money and inflation, they're going to do it in gold and silver. They're not going to do it in the bond market. So you got to beat them to it. It's not too late. I've been pounding the table for people to buy gold and silver. Certainly all year, I've been really saying that, ever since the Fed hiked rates and we had that move in gold went down to 1050. That was a great buying opportunity, and then immediately spiked up. But we're still much closer to the bottom than the top. So there's plenty of opportunity for people to buy both metals. In fact, I mentioned on this podcast not too long ago, there were some idiots who were actually shorting silver and buying gold because the ratio had broken out to a new high for gold, a new low for silver, and these idiots took this as an opportunity to short silver. I remember talking about, the best thing to do would be fade that trade. If something's at a record low, you don't want to sell it, you want to buy it, which is what should have been done. And I still think that there's a long way for that trade to unravel, and there are a lot of shorts out there. There are a lot of hedge funds. Remember all the hedge funds that were short? There was a record amount of shorts. In fact, for the first time ever, when the year ended, hedge funds were net short gold and silver. Now, some of those funds have covered, but all of them haven't. I bet there's still some shorts out there. So there's going to be some real disasters coming for the speculators who were dumb enough to short gold and silver. Meanwhile, the financials, the U.S. financials have come up a bit, but the European financials, they barely budge. They're still right near the lows. So you've got financials getting crushed. You've got gold going way up. This is a very, very problematic sign for the people who think all is well and that the central bankers have all this under control. They don't have anything under control, and it's about to get out of control. Meanwhile, I want to remind everybody, if you are not coming to Freedom Fest in Las Vegas, it's not too late to get a ticket to Vegas. I'm going to be there for 4 days? I think it starts July 12th, 13th. I think it's at Caesar's Palace, 4-day event. It's a great fun. A lot of other great speakers, in addition to me, will be there. I'll have some of the guys there from Euro Pacific Capital. We have a booth. So you can hang out with me at the booth. You can talk to some of the brokers, go to my workshops, listen to my talk, just hang out, grab a drink with me. I'm there for the whole conference. It's a lot of fun. There's a lot of good people there. Freedom Fest. Unfortunately, there's not a lot of freedom left to be festive about. So it's more about the freedom that we want rather than the freedom that we have. But anyway, looking forward to seeing many of you there. And again, have a great holiday weekend. And I think the real fireworks, though, might start on Tuesday when our markets open up after the 3-day holiday weekend.
Today's financial advisors behave like pro wrestling TV commentators. They scream that the recovery is strong, debt is manageable, inflation is low, and that the Federal Reserve has everything under control. They may be oblivious, but the danger is real. Looking beyond the media hype can open a world of broader investing ideas. Euro Pacific Capital is a registered investment advisor that offers stock-focused wealth management services that closely follow the strategy of our founder and CEO, Peter Schiff. We concentrate on those countries that are more closely in tune with Peter's vision of how capitalism is supposed to work. And these investments are not hard to find, provided you know where to look. Isn't it time you change the channel and let Euro Pacific put a little reality back into your portfolio? If you live in the United States and have $25,000 or more to invest, call 800-727-7922. That's 800-727-7922. Non-U.S. residents access similar strategies through Euro Pacific Bank at europacbank.com. Euro Pacific Capital and Euro Pacific Bank are affiliated companies.